Okay, great. Well, welcome everybody to workshop number 3, where we're going to cover the second half of due diligence. This is our last workshop, sadly, before the final event. Tonight, we are going to cover management team, financials and projections, returns. We're going to talk a little bit about crafting an investment deck. Then we'll review deadlines and then answer questions. And then as a reminder, last week's training has been posted on the website. So if you missed that or you want to go back through it and see if there's anything that you might have missed or anything that might be helpful, that is up and on the website. All right, so quick thing on deliverables. The deliverable, I know there's been a little bit of confusion there, so just to iron it out. The deliverable is going to be a presentation, so like a pitch deck. Should be somewhere between 10 to 15 slides, and it should cover the following aspects of your deal. And we will post this on the website as well, this list, just to make sure that you have the correct format and you're hitting all the right things. So it should include the offering. So the offering is going to be what it is you're buying with your dollars in terms of an investment. Are you buying equity? Are you buying a convertible note? What are the terms of the equity or the note, right? What's the valuation? How much of the company are you getting? Those kinds of things. How much are you recommending should be invested? And as a reminder, you're basing your decision off of a $50 million fund. So keep that in mind as you make your investment recommendation. It should include a description of the business and its strategy, what makes it unique and competitive in the market. Should include a management assessment, a market analysis, a competitive landscape analysis, historical and financial projections, an exit strategy and projected returns, and then you should kind of sum it all up together with your investment thesis at the end as to why you think this is a good investment. You'll have 10 to 15 minutes to present, plus 8 to 10 minutes of Q&A. So that's not a lot of time. You're basically going to get roughly a minute per slide. So keep that in mind as you're designing your slides and putting in the relevant information. All right, so let's go through some of these things that we haven't covered then. So the offering, what kind of security are you buying? Now, ultimately, from an investor perspective, particularly in the private markets, there's basically three types of investments. There's equity, and then there's 2 different types of debt. So with equity, you're actually buying part of the company, right? And in venture capital, there's this concept of pre and post money. And the reason for that is because you're making an investment in a company where the goal is to really grow the business, right? And so the money isn't going to buy somebody else's shares like it would be on the public markets, or if you were in private equity and you go and you buy a whole company from somebody else. Really, the money is going in, and it's in a roundabout way buying equity from founders, but really it's diluting them more than anything else because that money is going into the business to help it grow. And because it's helping it grow, there's this concept that like $1 that I put in should be worth $1 like a minute after I give it to the company, right? And so a pre-money valuation is simply the value of the business before they raise any more investment dollars. And then the post-money takes that valuation and it adds all of the dollars that came in as investment, and that the sum of those two gives you your post-money, right? And so if my companies were $10 million and I raised $5 million in investment, right, then my pre-money is $10 million and my post-money is $15 million. And it's assumed, right, that like I'm going to that $5 million didn't lose value the minute I invested. Now, over time, my hope is, the reason I'm giving them that money is I'm hoping that they can take $5 million and they can turn it into $10 million or $20 million or $30 million or whatever it might be, right? Depending on what kind of efficiencies and scale and so forth the company has. And so that's how the valuation goes up for the next round, right? So I put in $5 million and they just go gangbusters with that $5 million and they get huge amounts of leverage off of it, right? And they turn that 5 million into 20 million, let's say, right? Now the valuation of the company from a pre-money perspective should be somewhere around $30 million, right? 10 million from the first round, plus we took that 5 and we really grew it into 20 million. And so now the company altogether is worth 30 million as a pre-money, and then they'll raise more money, and that's going to carry a post-money and so on and so forth, right? Does that make sense? The next thing to think about is downside protection. Now, there are a lot of other terms, but I don't think you really need to worry about those other terms. The ones I'm going to cover tonight are the most important. So downside protection is probably the next most important thing that you should be thinking about as a VC investor. And in equity, typically what you're doing is you're investing in preferred, or as a venture capitalist, you're investing in preferred shares. And preferred shares often, if not always, carry what's called a liquidation preference. And essentially the way a liquidation preference works is it says that the preferred shareholders should get paid back before the common shareholders, but after the debt, right? So it kind of sits in between. And it gives you a little bit better downside protection. Now, there's only a few things to keep in mind here with liquidation preference. One is it's usually, the most common is what's called a 1x non-participating preferred liquidation preference, wherein basically if I put $1 million in and the company sells for an amount under a valuation under which I would get, like based on my ownership percentage, $1 million back, I will get my $1 million back first. So if we think about my example earlier where we invested $5 million in a company worth $10 million on a pre-money basis, on a post-money, I'm going to own a third of the business, right? Well, what happens if that company ultimately ends up selling for $10 million, right? Well, if I just invested in common, then I would own a third of that. So I would get, $3.3 million back. And so I would lose a little bit I would lose, $1.6 million, $7 million, off of my investment. What a liquidation preference would do is say, no, you're not going to get your percentage back. You're going to get the amount you invested back. So if you put in $5 million, if the company sells for $5 million, you're going to get $5 million back first. And then the common will split whatever is left, that remaining $5 million. So that's essentially how a liquidation preference works. Now it could be, there's another type that you might run into called a participating preferred. And what it basically says is you're going to get your ownership percentage plus you're going to get your $5 million back in the event that there's an illiquidity event. The company gets acquired or gets acquired usually. So in that case, right, let's say, same example, that $10 million exit, I'm going to get my $5 million back, and then I'm going to still retain my ownership percentage in the company of 30%. And so that remaining $5 million is going to be split 70-30 between me and the other common shareholders So in that case, I would get another third of that of that $5 million, right? Does that make sense? So even though the company ended up selling for a valuation under where I invested, I still made money. And that's kind of the power of participating preferred. Now, I would say participating preferred is very kind of investor friendly, and you don't see it super often. You also can add multiples onto the liquidation preference. So it could be like a 2x or a 3x liquidation preference. And in that case, you would get 2 or 3 times your investment back. But that's fairly uncommon as well. And then there's a bunch of other things. There'll be like buybacks and so on and so forth. I wouldn't worry too much about those types of things. you're unlikely to get in the weeds too much on that. And frankly, they typically don't matter a whole lot. Now, the next type, and frankly, my guess is that a lot of the investments you're looking at will be more along these lines, is convertible debt. So convertible debt, the idea behind it is I don't know what the value of the company should be because it's too early. They haven't proven out things. They may not have like real meaningful revenue yet. And so I want to kick the can down the road in terms of setting a valuation on the business, right? Both the entrepreneurs want that because they don't want this thing to be valued too soon and give up too much equity in the company. And on the flip side, as an investor, right, I don't know either what it should be valued at. And so I do convertible debt. And with a convertible debt investment, the benefit there is if you look down at downside protection is I get paid back first because it's debt, right? So I'm going to get my money back first. Now, in terms of valuation, most convertible debt these days does have a valuation tied to it, and that is typically a valuation cap. So you'll see things like this company is raising money on a convertible note with a $10 million cap. And what that means is that when my debt converts from debt into equity, it won't convert at a valuation higher than $10 million, right? That's the cap at which it will convert. And that's important because as an investor, right, the worst thing that you could do, I mean, not the worst, but I mean, it wouldn't be great, is you could invest in a company in the convertible debt, but with no cap. And then the company just takes off and they're wildly successful. And they go off and they raise their next round of funding at $100 million and you convert at $100 million, the same price as the new investors coming in, right? Well, that's not really fair because you took all of this risk really in the early days when things were uncertain. And so that's why you have the cap, is to provide some protection in case, they just go gangbusters and are super successful. The other thing the other two terms that are important is the interest rate. So there's oftentimes an interest rate unless it is a safe, which is another type of convertible debt essentially. And a safe doesn't typically have an interest rate. But if you'll notice there, I wrote that it's a PIK interest, and PIK stands for paid in kind. What that means is that the company's not going to cut you a check every month or every year on the interest from your investment. What they're going to do is they're going to just add it to what they owe you when they convert your debt into equity. And so your position just kind of grows and accumulates interest over time that will eventually be converted into equity. And then the last piece is a conversion discount. So this is also tied with the valuation cap. And the way it works is it says at that future round that you raise money and my note converts into equity, I should get some discount to that valuation, especially if that valuation is under the valuation cap that we agreed to earlier. So in that case, you'd say, okay, I think I'm willing to agree to a $10 million valuation cap on the business, right? So my investment in this convertible debt won't convert at a valuation above $10 million, right? So if I put in $1 million, I'm going to end up owning a little less than 10% of the company, right? If they raised at like a 20 or a $30 million valuation, right? Because I have that $10 million cap. Now, the other thing that could happen, though, is what if they raise money at less than a $10 million valuation? Well, in that case, I still should get a benefit because I came in early. I took that risk, right, relative to other investors. And so that's where the conversion discount comes into play. So in your diligence, you may have come across things such as a 10% or a 20% discount to the next round. And that's just saying that the valuation at which your money will convert into equity will be 20% or 10%, whatever it is, lower than the valuation at which they're raising money. So back to our example, if the company has a $10 million cap but they end up raising at a $5 million valuation, and I have a 20% discount, conversion discount, then that means my $1 million investment is going to convert at a $4 million valuation and not a $5 million valuation, if that makes sense. So I get a little bit of a better deal there. The last one doesn't really qualify for this competition, but I do think it's worth discussing, and that is just pure debt. So companies can raise, and often do raise, what's called venture debt, and it doesn't have a valuation. It does have a first lien. It usually sits before convertible debt. It'll have an interest rate. That interest rate may just accumulate over time in terms of what they owe, and then they'll have one big balloon payment at the end. Or it could be something that they pay on a monthly, quarterly, or annual basis. And then, the other kind of thing to keep in mind is that usually they have a term. So it's, 2 years, 3 years, 5 years, what have you. So it's important to understand what are you buying. So when you're drafting your presentation, you want to know, is it equity or is it convertible debt? And if it's equity, you need to tell us what the pre-money and the post-money are. You need to tell us if there's a liquidation preference and what kind of downside protections are in place. If it's a convertible note or a SAFE, you need to indicate if there's a valuation cap, if there's interest, particularly if it's convertible debt, and if there's a conversion discount as well. All right, hopefully that made sense. If you have questions on that, I know I just covered a lot there. Feel free to drop it in the chat, and happy to come back to it. All right, so moving on. Oh, I guess the last thing I'll note here is it's really important to know what you're buying and at what price, because it's going to tell you how much of the company you're going to end up owning. And that's going to be important when we get to the return section. Okay, management. So, there's an old saying, what's more important, the horse or the jockey, right? I tend to believe that it's a little bit of both. Both are important, both the jockey and the horse. Although that being said, if you had to choose between an A team and a B company, and a B company and an A team, wait a second, I just said the same thing again. An A company and a B team, you would probably want to invest in the company that has an A team, even though it's maybe not the very best idea or best business model or whatever. And the reason for that is because a really great team will figure it out, right? They'll pivot, they'll change, they'll work hard, and they'll find a way to make it successful. Which is important because in startup land, nothing goes to plan. So all the companies that you guys are looking at the seed stage, it's highly unlikely that that company will look anything like it does today in the future if they are successful. So even if you think about like some of the biggest companies like Uber, right? When they started, it was only black car service, right? And most of the drivers that were on the platform actually worked for somebody else that managed a bunch of black cars. That was what Uber looked like in the very, very beginning. And they were like that for a long time until Lyft came around and said, hey, we're gonna do this whole peer-to-peer thing and really open it up. And that's when Uber launched UberX, which was moving away from black cars and making it more accessible to anybody that wanted to hop on the app and start driving for Uber. So these companies, they change a lot. And so you want a management team that can adapt, right? And change with them. So things that I think about when I'm looking at management teams, given the industry and key risks, do they have the right people? So that might be, let me give you an example. We're an investor in a company called Fair. And Fair does used car leasing. So if you want to drive like a BMW, but you can't afford a brand new BMW, you could lease a used, like a 2-year or 3-year used BMW on Fair. And, it's only a few years older, so it's still really nice and in good condition. And it's way cheaper than leasing it brand new. So if you think about like, what does a team need to look like for that? Well, it's a very asset heavy team or in business model, right? Because you got to go out and buy cars essentially. So you need somebody that knows how to raise money. And it just so happens that the CEO, Scott Painter, is really good at raising money, right? Almost to a fault. But you can kind of check that box. The other thing that they need to be able to do really well is they need to be able to underwrite the risk, right? And the depreciation of these cars. Because if I lease it, right, they need to be able to model the lease payments so that they cover any depreciation loss, maintenance loss, wear and tear loss, risk of, destruction or property loss or what have you, and still generate a good profit. And so the other guy, one of the other guys they have on their team is a guy that's built the whole finance team at Tesla and BMW and Mercedes. So he has a tremendous amount of experience building teams and evaluating the price of cars and lease agreements and so on and so forth, right? So that's what I mean by like, do they have relevant experience? And given the key risks, do they have the right people to address those potential issues? Do they have the right people given the size? So sometimes we'll look at deals where the company has staffed up too aggressively. They've started to scale their business before they're really ready, right? So they've got like 50 people, but they're only generating, a few $1 million in revenue. Well, that's probably like they just scaled too quickly, and now they're going to burn through a lot of the cash they have on hand, your investment dollars, and not achieve much because they just have too many people. It could also be the case where the company's growing really fast and they don't have enough people, right? And so in that case, I would want to know like what's their hiring plan and how do they think about that, and are they going to have the right people in place? Another thing to look for is sometimes you'll have people that have, or companies that have people that are just way too experienced for the role, given the size of the company. So the one I see most common there is CFOs. You'll have this teeny little startup and it's like 10 to 15 people, and they have a full-fledged CFO that's like done a ton of crazy stuff and he's working full-time at the company. Like, frankly, like that's a waste of money. They could get away with either a part-time CFO or even just like, a smart kid that knows how to do accounting and finance, and it kind of fills a VP of finance role. So watch for that, because it can be a red flag that maybe the company's not as sophisticated as they should be, right? And then the last one that I think a lot about is team market fit. So this kind of goes back to the first question, but is this the right team for this market? So I'll give you a couple examples. One, we're looking at a deal in the insurtech space where the CEO and his co-founders came out of a very large insurance company, right? They understand the market. They've spent a lot of time evaluating the space. They have a lot of industry connections. They understand insurance at a very deep level. And so when you compare their company against other insurtech companies in the same space, those other companies are oftentimes run by technologists that don't have that same experience in the insurance space. So they don't quite understand the challenges and pain points to the same degree. Another thing that I look for here that's closely related is there's this concept of an earned secret. And the idea behind an earned secret is there are lots of business opportunities out there that exist but are unknown because there aren't people that have spent the time and energy and effort to really understand that industry at a deep level and to find the areas where things don't work and they break, right? That's the idea of an earned secret. You've been in the industry, you've worked really hard, you've identified this problem that's not obvious to other people, and you use that to get started, right? So that could be another indication of team market fit. So those are the kinds of things you want to look for. I would highly recommend reading blog posts, podcast interviews, watching videos of the founders. Get a feel for them. Are they the right kind of people? They have the right kind of leadership skills? Do you think they'll be able to raise money, subsequent rounds of capital? Do you think they'll be able to attract really top tier talent to their team to help them succeed? Do they have the right background, the right experience, the right connections to really succeed in that industry or not, right? A lot of your companies are probably going to be too new to have a whole lot of information on Glassdoor, but Glassdoor is awesome if they do. So if they've probably got somewhere between 10 and 30 employees, they might start showing up on Glassdoor, and you can find out some really interesting things there. Read all the reviews, the good and the bad. Look for info regarding management's direction of the company, the culture, et cetera, and look for signs of turnover. So what you'll find is, just like any reviews, there's some people that are just like over the moon, some people that are bots, not really people, or they're not being entirely truthful, right? And then you have people that had one bad experience with one manager, and it's not really reflective of the overall company, but they get on and really rant and complain. What's useful though is when you read all of them, you can start to kind of get a feel for the culture of the company. We looked at one deal that was super eye-opening that we thought it was super interesting company, seemed like a great CEO, really great customer list. We went on Glassdoor and review after review after review where employees basically saying that the CEO lied frequently about the performance of the business and lied to other people and all kinds of things. And that was a really easy pencils down. We're not going to even bother engaging anymore on that deal because of that, right? You want to pay attention to employee turnover. Turnover can be a huge pain point for companies because you got to constantly retrain and redevelop talent and get them up the learning curve. And so if they constantly are leaving, it can be really damaging and really hard to grow and scale a business. And it can also be a red flag that can tell you, maybe there's an issue here with the management team, or maybe there's an issue with the culture that should be addressed. It's going to be a really big problem as the company gets bigger and scales. All right, so that's management. I would say just some tips of advice on pulling together your deck and your investment analysis. Identify the key players, right? Think about the business. What do they need to have in order to be successful? And then pick the players at the company, right? The employees, the founders, or whatever that you think are the most relevant and important, and talk about them. And don't be afraid to highlight holes. This is analysis. Not everything has to be sunshine and perfect, right? And companies will have warts. I think there's value in finding kind of some of the risks. Every business that we look at, there are more reasons to not do the deal than there are reasons to do the deal. But you do want to go into deals eyes wide open. And so it's super valuable to highlight, any potential risks and then use it to your advantage. Say, hey, look, this company really needs a chief marketing officer because they're a consumer products company and they don't really have anybody that does that, right? But we think, we're going to make this investment. We're still recommending this investment because our hope is that the company will then use those dollars to go and hire a CMO. And that, that's something that we will highly encourage the company to do, right? And that's okay. All right, so moving on, financials. So some of this is going to be super basic for some of you, and I get that this will be a little bit boring, but Some of you may not have engaged much with financials. So we're going to just go through the very basic stuff to make sure that everybody's on the same page and has the information they need in order to submit a good analysis. So in your analysis, you want to have you want to show an income statement, both historical income statement and projected income statement of what you think the company or what the company thinks that they can do from a revenue perspective. So revenue, that's just money that's coming in the door in exchange for a good or service, right? That's, when I sell my widget for $10, that $10 is revenue, right? Cost of goods sold, that's what it costs me to make that widget or provide that service. And then I have gross profit of $75 in this case. That's how much, that's basically just the difference between my revenue and what it cost me to deliver that revenue. Those usually capture most of your variable expenses is kind of the idea. And then you move on to operating expenses. And operating expenses, these are a little bit more fixed. So you've got sales, general, admin. So this is basically like the CEO salary, the office expense, any other like support staff, all those kinds of things fall into this bucket. Now I pulled out marketing expense separately. And the reason for that is because it is pseudo variable. And what I mean by that is that hopefully if you're doing a good job in marketing, it varies with your revenue. Now, the reason why it's not truly variable is because I could spend a ton of money in marketing and do a crappy job of it. And that's just a straight fixed expense, right? Money out the door. So you want to watch it. The other reason you want to watch it is because it should give you an idea around how valuable the product is. If I have to spend a ton of money on marketing to get anybody to even care about buying my product, I probably don't have that compelling of a product, right? So looking at kind of marketing to revenue ratios can be really helpful. After you take out those expenses, you're left with EBITDA, and EBITDA stands for earnings before interest, depreciation, and amortization. The idea behind EBITDA is this is what our machine generates, right? I put in $1 of revenue, how much comes out of the bottom of EBITDA in terms of cash. And allows us to compare one company against another based on how well they're operating, given their cost structure of cost of goods sold and operating expenses. After EBITDA, you're going to take out interest and depreciation, which gives you a number that you can use to calculate your tax rate. And from there, you're going to calculate your net income, which gives you your profit margin, which is simply your net income divided by your revenue. Now, I will admit that most of you are not going to find companies that are net income positive. They're probably all losing money, which is why they're raising money from funds like yours. But it is important to understand how these things flow through. All right, so given that is the income statement. I think for this exercise, if you want to include balance sheet and statement of cash flows, if you have access to them, that's great. But I think keeping it to income statement is fine for this competition. When you look at the historical financials, what are some things that you want to analyze and be thinking about? Well, one, how have they grown historically? What have they figured out versus proven? So this is a question I ask myself a lot when I'm evaluating a company. What have you figured out versus what have you proven? So if you look at the company, and like a great example of this is like marketing, right? If you've figured out that if we put $1 into marketing on social media, it's going to generate, X number of dollars, that's good. But what's even better is if you can prove that at scale, right? So that might work if you're just plowing in $100, but what happens if we plow in $1 million, right? And so what you'd want to see is as marketing spend increases, marketing efficiency, which is a simple metric, could even be as simple as just marketing divided by revenue, right? Or vice versa. Is that remaining constant? or is it improving or degrading over time, right? Another one to look at, are they growing quarter over quarter, year over year? Ideally, you want to invest in companies that are growing really fast year over year. And I would look for companies that are growing at least 100% year over year. Because when you're really small, it's really easy to grow high percentages, right? And the bigger you get, it becomes more and more challenging. And so if a company is only growing like 10% and they're generating $1 million in revenue, $1 million in revenue is really small, frankly, from where you want it to get to. So to grow 10%, I mean, it's just not gonna be a good venture deal, right? At the end of the day, you want this thing to grow from $1 million to $2 million to $4 million to $8 million to $16 million to 30, right? $32 million to $64 million to 100, right? That's what you want. You want to see that kind of growth over time. And ideally, you want to see even better than 100% year over year for seed stage companies. Oftentimes, the last thing I'll just note on there is that growth can be a really good indicator of is the company solving a real pain point or not, right? If people are begging for the solution, right, then it should be easy to sell, and that should be a really good early indicator that they're on to something really interesting, right? Understand the next thing you want to do is you really want to understand the unit economics and key drivers of the business. So taking the time to understand their underlying business model and what drives revenue. Is it marketing dollars that drive revenue? Is it number of sales reps? Is it partners that they have? Is it retail locations? Is it users? Is it transactions? What is it in their business model that really drives revenue? So I'll give you a really quick example of all of these to hopefully make it a little more concrete. So marketing, right? Let's say I sell widgets. I need to do some marketing online in order to tell people about the widget that I've created so that they'll get excited and buy it, right? So how much money do I spend on marketing versus how much does that generate? How much do I generate in revenue? Sales reps. Let's say I sell enterprise software. So I sell software to large companies. Well, I'm going to spend money on marketing, but probably more importantly, I'm going to have sales reps that are calling up the companies and talking with them about why the software really solve their needs and pain points and so on and so forth. And so maybe I need to have a lot of sales reps, right? And each sales rep is going to generate X amount in sales per year, et cetera, et cetera. Another one could be partners. So like a retail partner. So we're an investor in a company called Kopari, and they sell through Ulta and Sephora. And so it's important to know how many doors they're in, how many retail locations with Sephora and Ulta are they in, because it gives us an indication of how much sales we can project that they will do through those locations, right? It could be users. So, if you're Spotify, right, you want to be keeping track of how many users you have, both free and paid, because each of those users are going to pay you, right? So tracking that can be important. It could also be like Facebook, where you want to track number of users, because the more users you have, the more people the advertisers can advertise to. And then the last one is kind of an interesting one, and that's transactions. So a good example of that is our investment in Toast. So Toast does point of sale, so like kind of the register at restaurants. Pay attention next time you're at a restaurant. There's a good chance that they're using Toast. Well, Toast makes money on the software piece of it, but most of the money they make is actually they take a cut of every transaction. And so for them, the number of transactions per restaurant is actually really important. So take the time to really understand the business model and what are the key drivers behind it. And then ask yourself, does the growth make sense? Companies usually grow at declining growth rates. So be sure to step back and think about it. So oftentimes what we'll see is companies they'll grow like this, right? And in the first year, they'll grow like 100%. And then the next year they're growing like 150% year over year. And then the year after that, it's like 200% year over year. That very, very rarely happens. It is very hard to accelerate growth in a business. Typically what happens is you grow 100% and then you grow 50% and then you grow 25%, right? Or something along those lines. So, look at what their metrics are, look at it from a high level and just double check and make sure that everything makes sense, that growing at that rate is actually achievable. All right, so talking a little bit about unit economics, some things that are important here. So unit economics refers to an analysis of the sale of one unit of good, right, or service. So if I sell one unit for $100 and my cost of goods sold is $50, then that's going to give me a gross profit of $50 and gross margin of 50%. But that's not enough. I also need to know how much of that is what we call contribution margin. And if you notice, contribution margin didn't show up on the income statement. It's because it's not really an income statement kind of thing. But it is incredibly helpful to understanding a business. So oftentimes what you'll see is companies will say, well, my cost to acquire a customer is $20 and I generate $100 from them in revenue. But they didn't, therefore, I have a CAC to, LTV or revenue ratio of 5, which is great. But you also have to take out cost of goods sold because that has to be paid out immediately too. So that takes you down from 100 to 50, and all of a sudden that cuts that ratio in half, right? And that's important because this contribution margin should capture everything that is variable. So then you know exactly what your fixed costs are going to look like. And this is important because oftentimes you'll have companies that are losing money, right? And it's hard to know, is the company losing money because their fixed costs are just really high, but they are generating a decent amount of contribution margin on every sale. And so as they scale and get bigger, they'll be able to pay off, or not pay off, but cover those fixed expenses? Or is it the case where the company is basically selling dollars for 90 cents, right? Right. I'm going to provide you a service, but I'm going to underprice it so low that it's a no-brainer for most people to sign up and do it, right? You don't want to be in that type of business because the more you scale, the more it hurts. Once you've figured out your unit economics, right, and determined whether or not you're selling dollars for 90 cents or dollars for $2, which is hopefully more the case, then you want to be looking at not just that one purchase, but what does that one customer look like over time, right? So let's say that customer buys the product every year over a course of 10 years. Well, that's $1,000 of lifetime value of that customer, right? And so in that case, it could be even more expensive to acquire the customer, like $300. You see this a lot in enterprise software where you have recurring revenue, right? Every year that customer comes back and they pay for another year of the product. Good examples of this would be things like Spotify, right? Like every month or every year, or Netflix, right? Like you pay a subscription for access to that service, right? And, over time, there's some likelihood that eventually you'll replace Netflix with something else, or it'll get too expensive, or you just won't be interested in it anymore, and so you'll drop off. And basically, from the time you started and the time you dropped off, all of that money you've paid to Netflix, that becomes your lifetime value. And then there's this question of how much did it cost Netflix and marketing expenses to get you on board, right? That's your cost to acquire. So for a lot of businesses, it may cost them as much or more than they generate in revenue in the first year. So that's what's happening in this case on the presentation. The company, it costs them $300 to acquire that customer, and that customer may only be generating $100 per year, right? But they're going to be with the customer. They're going to be a customer for 10 years. So that's $1,000 of lifetime value. So in that case, their CAC to LTV ratio, their cost of customer acquisition, right? Or customer acquisition cost to their lifetime value ratio is 3.3x. And in that case, the company is going to look like it's losing a lot of money for a while until eventually it turns a profit, right? 3 years, right? It's going to be losing money essentially for 3 years before it'll flip things around and start generating money. Then you have cost of goods sold. So you also have to take that out of it, right? That's going to leave you with contribution margin. And so depending on how you want to calculate it, you could have different LTV to CAC ratios. My recommendation is oftentimes companies will say, oh yeah, we have an LTV CAC ratio of 3. What you should be asking is, how did you calculate your lifetime value, and how did you calculate your cost to acquire, and how did you calculate that ratio? Is your lifetime value based on just revenue coming in the door, or is it more of a contribution margin that takes out all your other variable expenses, primarily cost of goods sold, right? So pay attention to that, because companies could say, yeah, we have a 3x LTV to CAC ratio, but that's on a revenue basis. And once you take out the contribution or the cost of goods sold, all of a sudden that their lifetime value is only $500. Now their LTV to CAC ratio has dropped from 3.3x to 1.1 2/3, right? So it's a lot worse, right? Now you could still maybe make the argument that you would want to do it, but the other thing to keep in mind is that your payback period is now not 3 years, like I have indicated down there below, but it's really 6 years, which means you have to finance that company for 6 years, essentially, right? Before they're going to start turning a profit, which can be a really big challenge and not a great business model. So this is where it can be helpful to dig into these numbers a little bit more if you have access to this information. All right, so let's talk a little bit about financial projections. So understand the key drivers of your model is the most important thing, right? That's going back a couple slides to here, where we talked about what are the key drivers. Is it marketing dollars? Is it sales reps? Is it partners? Is it users? Is it transactions, et cetera, et cetera? So you're going to figure out what are those key drivers, and then you're going to evaluate kind of what are the underlying assumptions, right? So if the company says, oh yeah, we're going to grow to $13 million in, next year, but that's going to require them to onboard, a ton of new retail locations. And you think about it and how hard it was for them to launch the retail locations they're in. It took them 5 years to get the number of retail locations they have today. And now they need to basically double that in a year. And you look at it and say, well, they have to have a lot of staff in order to do that, or whatever it might be, right? Then that forecast might be unrealistic. And you might want to pare it back to something that is more realistic based on those key drivers. Another one of those key drivers could be marketing spend. So you could say, well, okay, what we've seen historically is every dollar you spend in marketing generates $2 in revenue. And you're going to double revenue next year, which means that you really need to double marketing spend, which means in this case, it's $13 million. So you're going to spend $6.5 million, but we're only going to give you $1 million in this round, right? So maybe that's unrealistic that you guys are going to grow that much, right? Whatever it might be. Keep in mind, in order to grow, you either need to increase the number of customers, or you need customers to buy more. Either is fine, but you better be able to defend either case. I would say generally it's easier to get more customers than it is to get customers to buy more from a perspective of just pure growth, right? Probably easier to find one more customer than it is to convince a current customer to double their market or their spend with you, right? For example. But great companies generate revenue from both. All right, so we're going to move on. hopefully that gives you some basic guidelines of things you need to be thinking about from your financials, both historical as well as forecasting into the future. So just to reiterate, on historicals, look at how they've been growing historically. Are there any like big red flags, like revenue went flat, or is it really good and revenue just keeps going up month over month, quarter over quarter, and it's really exciting, and they're just solving this massive pain point. Everybody's just begging them to get their hands on the product, et cetera, right? What's going on there? Then it's also important to understand both historical and looking forward, like what are the key drivers of this business, right? Is it sales reps? Is it marketing spend? Is it like number of doors that they're in? Whatever it might be, right? And understanding that, and how does that change over time and into the future, right? To really drive growth of the business. All right, so next section, let's talk about exit strategy and projected returns. So one of the unique things about venture capital, unlike investing in the public markets, and even investing in different private equity type investments, is that VCs require liquidity events. The liquidity events is simply like an opportunity for you to sell your stock in the company, and they're pretty rare in the private market, right? That's why they're private. That stock is not freely exchangeable. So there's basically three avenues of liquidity, right? One is M&A. Somebody buys your business. The next one is an IPO. So that's where the company decides that they need to raise more money, and they go to the public markets and they raise it from the public markets. And the last is bankruptcy, which, hopefully we can avoid, right? But it is a liquidity event because, the company is going to liquidate everything that they own, and they're going to, all the computers and desk space and products and inventory and all that stuff, and then they're going to give it back to their lenders and to their equity holders. So in your analysis, you need to figure out how are you going to get your money back, right? And you need to make a case for why the company that you're investing in is the type of company that could get to an IPO or be acquired. And let me just say that there are lots of great businesses out there. In fact, the majority of privately owned businesses do not work for venture capital because they don't have the ability to get to a meaningful liquidity event. They're not going to get acquired for $1 billion or go public in a multi-billion-dollar valuation, right? But that doesn't mean that they're bad investments, right? If I invest in a McDonald's franchise, right, it's not really going to have a liquidity event, right? No big like private equity firm is going to come out and buy my one little McDonald's franchise, right? And there's no way my one little McDonald's franchise can go public, right? But it could generate tens of thousands or hundreds of thousands of dollars annually in profit that goes right in my pocket and could be a great business, right? But that's not what we're investing in venture. We're swinging for the fences. So we want companies that can sell for a huge number or go public. So when you're thinking about that, you should be asking yourself, is this the type of company that could be acquired? Who would buy them and why? Why would they buy them, right? What benefit would it give them? And I will tell you, probably the worst answer is, well, it would help them generate more revenue. If that's your only reason, then it's probably not the right reason for why a company would buy another one. Good reasons would be things like, well, it could open up a whole new market that they're not in, or there's a lot of synergies between their customers, right? So I can I can buy this company and I can take their product and I can push it through my distribution channels and I can sell more product to my current customer base. Or it could be like the product gives me a huge technological advantage that I really need to enhance my products so that more people will want them and buy them. So it could be a lot of those different things. So think about that. And then an IPO, the question there is, can they generate $100 million in revenue or more? So just to go through a few examples in our own portfolio, right? So we're an investor in a company called Health Catalyst. It's a Utah company. They're a great company. They've generated well in excess of $100 million in revenue. They do software as a service and data storage for large hospital systems. So you think about like how many big hospital systems are there out there and how much data there is flowing through them. Like that is a really big market. They've got really strong revenues, really strong management team. It's possible, right, that they could go public, which they ultimately did go public last year. You look at a company like ScoreStream, on the other hand. ScoreStream is a really interesting business. What they do is they use crowds to generate scores for local sports teams. So of the 9,000 football games, high school football games that happen every year, ScoreStream covers the scores for those football games at like 8,000 of them or something like that. And it's all user-generated content, and it's videos and scores and pictures, and they've got like a whole community around it. And they have now become the data provider of high school sports scores for a large number of media platforms, newspapers, as well as companies like Snapchat and Facebook and Amazon and so forth. But if you look at that sort of business, is it likely that they're going to go public? Probably not, right? But there probably are a lot of buyers for that data, right? And access to those users, right? So you could think about like maybe a Google buys them because they want access to that data, right? Because Google's all about data and they can find ways to monetize that data. Or maybe it's Facebook because Facebook is all about creating communities and in driving engagement within those communities. And the ScoreStream community is clearly very engaged because they're providing all of this data for free back to ScoreStream in terms of the sports scores and so forth. So part of it is a little bit like how big is the market? What's the business model look like? And what's the most realistic outcome? Is another question to ask is if an IPO or M&A makes more sense is, do you think this could be a standalone company for the next like 20 years, right? And if so, right, that they can continue to grow and they operate in a big market and a big enough market and can be a standalone business over like that 20-year period, then maybe an IPO is possible, right? But if you look at it and say, you know, this is a really cool product, but it would be an obvious like product addition to another larger company, then probably M&A is more relevant. All right, so that's going to be your exit strategy. How are you going to exit this thing? Is it going to be acquisition, IPO, or hopefully not bankruptcy, or is it going to really struggle to find an acquirer? I guess I'll add one more thing on M&A. Oftentimes, M&A, like exit strategy, can be a good way to provide some downside protection on a deal. So if you look at a company, you're like, wow, this company is made of a bunch of rock star engineers and they are building some incredible technology. Even if like they can't turn it into a real business, there are going to be buyers for this technology and this team, right? That can be something worth noting and saying, hey, look, they're solving this like massive problem around like, you know, self-driving trucks, right? But even if they fail, like everybody's trying to figure this out, and this team is like phenomenal and amazing, and they're going to build some really interesting technology, and that technology will be interesting to a lot of different people, right, that are looking to buy it. Okay, so moving on. So you figured out your exit strategy. Now you need to figure out what your returns are going to look like. What kind of, you know, return can you generate on your investment? The process of using market-driven valuations of similar companies to derive or estimate a target company's value. So that's what comparables analysis is all about. It's basically saying, I don't know what this company could be worth because valuation is so hard. There's so many factors that come into play. It's like, how fast is it growing? What's happening in the market? What are the other competitors doing? What is the government doing at any given time, right? Like, what are companies overseas doing? What are governments overseas doing? What are the trends in the market, right? Like all of a sudden people, you know, start drinking fizzy water because it's cool, right? And so that blows up one side of the market and crushes a whole other side of the market, right? As people shift their preferences. So valuation is hard. And it's hard. It's actually a good thing that it's hard, because if it were easy, anybody could do valuation and all stock prices would be exactly what they should be, and there would be no way to make any money. So, it's good that it's hard, but it's also hard. So how do you deal with that? Well, kind of a shortcut way to deal with valuation is to use comparables analysis. And the reason that comparables is so powerful is that you're basically leveraging the expertise and actions of thousands of investors, if not millions of investors, who are doing the hard work of putting a value on a company, right? Based on all the information that they know. And that all gets boiled down into the price at which a stock trades on the stock market, or the price at which a company gets acquired. So comps, how should you think about that? Well, I love thinking about it in terms of real estate. So let me explain why. If you think about, let's say you own one of the houses in that tract of houses down there, one of those little white ones, right? If you think about it, if you want to sell your house, what's going to be the very best way to price your house? Well, it's going to be your neighbor. The ideal comp is going to be your neighbor right next door, right, who owns the pretty much exact same house that sold it yesterday for the same reason that you're looking to sell your house, right? And by that, I mean that it wasn't distressed. They didn't just get divorced and have to liquidate assets. It's none of those. It's not like the owner died and the family just dumping the house, so they can get the money out of it, right? They sold it for the same reason that you did, is that like they're ready to move on to something else, right? That is going to be your best comp, right? It's going to have, so that's what you're shooting for. Now that can be really hard, because if you're investing in a company at the early stage, hopefully you're investing in something that's truly disruptive. It's new. It's operating in a quote new market, right? And it can be hard to find that perfect house. But that's what you should be thinking about. And so there are all these different aspects. One of those aspects is the market, right? And is it a similar type of market? But another could be business model, like we discussed at the beginning of this, right? Like look at the actual business model. Are they selling software? Are they selling widgets? Is it a marketplace, et cetera, et cetera? It might also be that you got to kind of aggregate a few different. So maybe you say, okay, I'm looking at Airbnb. Who's the comp for Airbnb when Airbnb is raising their seed round? Well, maybe it's eBay, because it's peer-to-peer marketplace, right? It's a similar business model, and they're taking a small cut of the transaction, right? Like eBay takes a cut of every transaction, just like Airbnb is going to take a cut of every transaction. So maybe I have an Airbnb or an eBay as a comp, but eBay isn't in real estate and in vacations or any of that kind of stuff. So maybe then I also look at hotels, like the Marriotts and the Hiltons of the world, because that's going to capture data around what's happening in the market and the competitive landscape and all of the things that are related to that industry or market. And then maybe I take those two and I kind of merge them and say, I think an Airbnb is going to trade somewhere between those two, right? So let me give you an example. This is pulled straight out of one of our investment memos in a deal we did called Quantenna. Now, Quantenna did high performance Wi-Fi chips. And so if you go to Best Buy and you buy the highest grade Wi-Fi router out there, there's a good chance that it's running a Quantenna design chip. And so what we did is we said, okay, they are the number one player. Like they build the very best Wi-Fi chips. So we're probably not going to have an easy time finding another company that makes the very best Wi-Fi chips, right? But can we find companies that make the very best chipset for their respective markets? And have a similar business model of designing the chip and then having it manufactured in China. That's called a fabless semiconductor business model. So we found these 5 different companies, Ambarella, Avago, Cavium, MPS, and Skyworks. And it turns out that each one is a leader within its own industry for the types of chipsets that it makes. So some make chipsets for photo and video equipment. Others make stuff for fiber optics and LED and microwave systems, and so on and so forth. So we said, okay, these are all the leaders, and they're all fabless semiconductor companies. So the business model is roughly the same. Then we want to look and say, like, how big are these companies, right? Because if really big companies should be more established, less risky that it's going to go out of business, but it also may not be growing as fast, right? So, we wanted to be thinking about revenue growth and size and those types of things. So that brings us down to that chart in the middle, right? So the first one we look at is enterprise value. The enterprise value, generally speaking, is the value of a business if you were to acquire the entire thing outright. So I want to go in, I want to buy the whole thing. And when I'm done, I own all of it. I don't owe anybody anything, right? So the calculation there is you buy all the equity and you buy all the debt, right? And then you own that thing outright. And then you're going to subtract off cash if there's any cash in the business, because that'd be like if I bought your wallet from you for $10, but there was a $5 bill inside, right? I really only paid $5 for the wallet, right? So same basic idea. So you're going to subtract out the cash, but that's what it's going to cost you, right, to buy that thing outright. That's your enterprise value. And that's what we care about, because if somebody else comes in to buy Quantenna, that's what they're going to pay. They're going to pay the enterprise value. And if the company goes public, they're going to be valued on an enterprise value basis at the end of the day. So we put down our enterprise value, and here you can see how all these companies match up in terms of their enterprise value, which should give you some indication of size and expectations of the company. So most of these companies are, in the single digit billions, and then we have a couple in double digit billions. So maybe right off the bat, you say Avago, look, they've been around since 1961. They're a really big company, maybe not the most comparable, right? So maybe we're going to not weight them as heavily when we put our numbers together. And Skyworks, still quite a bit bigger than our company. I'll tell you, our company, Quantenna, was not a $1 billion company yet. But the hope was that if they would continue to grow, they could be valued at that. And then you look at revenue, right? Like Quantenna was on track to do about $100 million when they went public. So, three of these companies are kind of in range. And then you're going to look at like, okay, are they generating positive EBITDA, right? All but one of them are. And our expectation in this case was that Quantenna would generate positive EBITDA when they went public. So that's good. And then we're going to have our multiples. So we have both a revenue to EV multiple and an EBITDA to EV multiple. And so what that basically is saying is, for every dollar in revenue that this company generates, right, like Ambarella, it's being valued $6.86 by investors, right? And on an EBITDA basis, every dollar that generates an EBITDA is being valued, the company is being valued at $28.86, right? So you can take those multiples and now you can apply them to your company, like Quantenna. So if Quantenna is doing $100 million in revenue, then you could say, well, it looks like the companies that are the closest, right? So it's going to be Ambarella, Cavium, and Monolithic, are all in that like 6.5 to 9x on a revenue basis. So, maybe we do something kind of in the middle, like 7x, right? Well, then the company should be worth about $700 million, right? They're doing $100 million in revenue, right? So that's kind of how you would think about it. And if you'll notice, the nice thing here is that the EV to revenue multiples are all pretty close. And even the EV to EBITDA multiples are pretty close in range. 28 to 54 isn't too bad of a range. And that should be a pretty good indicator that you're on the right track, is if your multiples are pretty tight. because that means that other investors are also looking at it the same way you are. And they're saying, in this broader industry and market, like these are the types of, this is how we value those businesses, is based on a multiple that's in this range. Just some other things that you want to consider when you're, if you're thinking about like, how do these businesses compare? You want to look at like revenue growth. So if you notice here in our chart, we've got 1-year revenue growth and 5-year revenue growth. So how much has revenue grown over a 5-year time period? And again, you'll notice like the numbers are pretty consistent across the board. I mean, they're not too far off in terms of growth rates and so forth. But you might say like, look, our business, Quantenna, is growing at like 50% year over year. So, maybe it should get a valuation that's a little higher, like Avago, because it's got good growth, right? And then the other thing to think about is margins. So sometimes you'll have businesses where you'll look at it and you'll say, well, this business has really, really high margins. This other one has really low margins. You can actually run a multiple on the margin. So you can say, I'm going to look at the gross profit to enterprise value multiple and use that instead if you have gross margins that are wildly different between your business and the comparable one. It's a question here on where you get this information. So there are a lot of resources. It can be as simple as like Google and Yahoo Finance. PitchBook's got some really great data. CapIQ has really great data if you have access to those resources through your universities. But if not, I mean, honestly, you can pull all of this information off of Yahoo Finance and other publicly available places. The other thing that you could look at is you could look at what's called precedent transactions. So these are other businesses that have been acquired. There's usually a lot less information available on them, but it can be, you can find some interesting things. So you could say like, hey, we're investing in a company that does security cameras, right? And so we look at how much Amazon paid for Ring back in the day, right? And you can find how much they generated in revenue, and you can find how much they got acquired for, and that number they got acquired for is their enterprise value. So you just divide that by the revenue they were generating, and that would give you a multiple on that. And that information, you can find it in PitchBook, but oftentimes you're just going to be like Google searching for acquisitions in the space and seeing what information you can find and what was reported in press releases and so forth. All right, so this is just a quick snapshot of something very simple that you can put together. The more complex you make it is great, but honestly, given the amount of time you guys have and the goals of the competition, something as simple as this is probably adequate, right? You might want to make it a little prettier, but that's kind of up to you. So one is put down your historical financials, right? Your actuals, and then forecast out what you think the financials will look like going forward. Find your comps, your comparables, and your multiple range, right? So, this comp bucket is like for a Spotify, right? So Pandora, Live Nation, Netflix, etc. And so you could have a bunch of EV to revenue multiples in there. Determine your ownership and implied exit value. So your ownership is going to be tied to the value, the offering, right, that we talked about at the beginning. If it's equity, again, and it's like a $10 million valuation and I put in $1 million, well, I'm going to own a little less than 10% of the company. If it's a convertible note, what I would recommend is that you use the valuation cap as a valuation, right? It's the most conservative way to do it. So you basically say, okay, if this company has a valuation cap of $10 million, then I'm just going to assume that my $1 million is going to convert at that $10 million cap. So in that case, I'll own a little less again than 10% of the company. And then from there, that tells you how much ownership you have, and then you can run your returns analysis. So that's your company. You basically find your company valuation. So in this case, you go up to your revenue and you say, we're going to do $8 million in revenue in this case, 2018. And on average, our multiple says we're going to get a 2.8x. So 2.8 times 8 million is going to be $22.6 million. If this is based on probably on a $100,000 investment, right? So I'm going to end up owning, in this case, 3.3%. So that's going to return $753,000, which will give me a 7.5x on my investment, right? My investment will have multiplied by 7.5 times, and then you can run an IRR calculation, which would generate a 96% IRR, which is pretty good, right? So you should have kind of this general idea of what you think the potential is. And here's what I'll say is the likelihood is that your company will go out of business because most businesses fail. That's okay. But what you're hoping is that even though that's the most likely case that your company goes out of business, if they're successful, that you will generate a huge return, right? Even better than 7.5x and 96% IRR that will more than compensate you for the risk of it potentially failing, right? And that's part of what you need to be able to demonstrate to the judges is, look, this company, yeah, it's risky, but the vision of what they're doing is huge and it's game changing. And if they can actually pull it off, this company could be worth $1 billion, and that would generate like 100x our investment and totally make it worth it, for example, right? Or if you're doing a company that's a little bit further along and not at the seed stage, maybe the return doesn't have to be 100x, right? But then the likelihood of them failing should also be lower as well. And all of the due diligence that you've done, the market, the competition, the management team, the strategy, the business model, all of that, ultimately you do it because you want to tease out what the likelihood is that this company will be successful. And the bigger the market and the stronger the management team and the more competitive they are versus the competition and, all of those different things, the more likely it is that they'll be successful, right? And so the more excited you should be about making the investment, given the potential returns on the backside. And tell you what, we will send out this Excel spreadsheet. It's just a very, very simple model, but at least you'll have something that you can work off of. If you want to change it and go above and beyond, you're more than welcome to. But at least you'll have a basic framework to work off of. All right. So you've done all of this work. You've analyzed the management team and the market and the competition and the financials, and you've figured out your exit strategy that somebody would actually want to buy this thing at some point if they, achieve X, Y, and Z goals. Now you need to boil it all down into your investment thesis. So the way I think about an investment thesis is this is like your elevator pitch on the deal. Imagine you're in an elevator and you've got to convince another investor to invest in this company that you're going to invest in. So you need to say, what does the company do? What's the market size and trends? Why the company will win relative to the competition? What's the historical traction and performance look like? What are the potential returns and why it fits your fund? And then how much you would recommend investing in the company. And then it's also helpful to identify what are the key risks and any mitigating factors. So for example, you'd be like, well, they don't have a chief marketing officer and they really need one. But the mitigating factor is we talked to the management team. They know that they need a chief marketing officer and they've got 2 that they're currently interviewing, right? So that sort of thing. I'll tell you a little bit of advice when it comes to case competitions. If you really want to win competitions, you identify what the key risks are, right? You identify the alternative solutions and you essentially discount them and explain why they don't work and why your solution is the obvious one. So in this case, you want to be proactive. You don't want the judges to think that like you were blindsided by anything. So you want to be able to say, look, these are risks. There are always risks on deals. We're aware of these risks. We just don't think that these are deal killers, given that the outcome, the potential of this company is so big. These are risks we're willing to take. And that's kind of how you're going to pull it all together and make the final pitch on why you're excited about the company and bring it all to a close. So just some things to think about. This is a reminder of all the things you want to include in your deck, right? So it's going to be, what is the pain point? Who is the customer? How does the company solve the pain point, right? And then how does the company make money when they solve that pain point? So if I'm Facebook, the pain point is, as an advertiser, all I know is that, I know that my marketing dollars, I know 50% of my marketing dollars are generating, revenue. I just don't know which 50%, right? I don't have good visibility. And so as an advertiser, I'm the customer for Facebook, and Facebook solves that pain point by giving me access to a ton of data so that I can target my customer very exactly and know that I'm getting in front of the people that are really relevant and important to get in front of and advertise to. And then Facebook monetizes that by charging me to, a fee to advertise on their platform, right? Every time somebody clicks on something, I pay Facebook for generating that traffic or that click. Market size. How big is the market? The TAM, SAM, SOM, right? How quickly is it growing? What's driving that growth? Make sure that you really understand kind of that market and what's happening there. Ideally, remember, you want to show that it's at least $1 billion market and growing, or it has the potential of becoming $1 billion market and growing. Competition. Who are the top competitors in the field, and how is your company positioned against them? And what are your company's sources of competitive advantage? What gives them, what makes them unique that you believe that they will be able to win against these other competitors in terms of attracting customers? Is it because their product is just so much better than the competitors? Is it because they're so much better at marketing, right? Like GoPro does not make the best action camera, but they're arguably like one of the best marketing companies in the world, right? So what is it that gives this company a competitive advantage? Make sure you cover the offering, right? What is the security you're buying and what are the key terms? Management, who are the key managers and why are they the right team to achieve success? And are there any holes or risks that you should be aware of? How do the historical financials look? Like, how has the company performed? And what are the key drivers of the business, and how do those key drivers fit into justifying the forecasted financials? What's the potential of this thing? And then you have your exit strategy and projected returns. So how do you anticipate exiting the investment via IPO or M&A, and why? Who's going to buy them if they're going to be acquired, and why would they buy them? What range of returns do you anticipate, right? So probably helpful to have an upside and a base case. And then why do these returns fit for your $50 million fund? Right. So if I make an investment and I'm only projecting I make $1 million investment and I'm only projecting to make 2x my money on that. So, $2 million return on a $50 million fund, that doesn't really move the needle. Right. What I want to do is invest $1 million and get $50 million back, ideally. Right. So, all right, cool. So that brings us to the end. Hopefully I've almost lost my voice, so hopefully you've learned something that's been helpful. Just a reminder that November 7th, your investment analysis is due. So that's coming up really soon here. You've got basically the weekend to get it done. or at least part of the weekend. And we will, you'll have until midnight, essentially. So 11:59 p.m. Get that in. And then we will go through it. And we will pick the top 5 teams, and probably the 9th or the 8th or the 10th, one of the two, we will announce the teams and we will pair you with mentors. We are really excited about the mentors this year. We've got people from Teleon Ventures, Album Ventures, Kickstart, Seed Fund, Signal Peak Ventures that have all agreed to help us this year as mentors. In years past, a lot of these individuals have invited teams into the office to present in the office, and really engaged, and helps a lot. And it's a big part of our fun, or our competition. So that should be really exciting. And they will give you feedback on your pitch, so you can refine it. And then your final pitch will be due November 17th. And so we can consolidate everything and have it ready for the final event. So I will stop there. And these dates are wrong, so we'll just keep on these and open it up for questions. Feel free to raise your hand if you want to talk, or feel free to throw it in the chat if you prefer that as well. Yes, Marcus.
Hey, so I just had a question on the revenue returning year over year, 100% growth. You mentioned that was something you look for. Are there ever situations where you'll accept lower year over year return in expectation that later on it will be much higher, or is that something that's maybe not investable at the moment if that's going on?
Look, I think ultimately, there could be cases where you say, look, this company is not generating revenue yet, but when they do generate revenue, they could generate a lot of revenue very quickly, right? And so making that case, I think is reasonable. Does that answer your question?
Yeah, thanks.
Yep. All right, what other questions? You answered all of them.
I have a quick question.
Yeah.
So, one of the companies that we sourced was not on any of the websites. It was just through somebody that we know.
Great.
And it is a private company. How do you get financial statements typically, or financial information from those kind of institutions, since it's not really public information?
Yeah, so this is where it's really tough. Ultimately, you can just reach out to them and ask, right? But there's a high likelihood that they may not be willing to share that with you. So that's why we encourage people to use those other resources like WeFunder, because they provide all the financial information already as part of it. But look, I mean, here's the thing that's really hard about venture capital, and hopefully you've learned this through part of the competition, and that is finding really great investment opportunities is hard, and convincing entrepreneurs to work with you is hard, right? But I think there's a lot of extra benefit to you competing if you find your own deal outside of one of these platforms and you convince the entrepreneur to give you access to that information, right? Because that's effectively what a VC would have to do as well. Is your investment analysis due only on one of the companies or all three? It's just one company. Just pick one company. Yep. We wanted you to turn in 3 because what happens if you're digging in and you find out that the CEO was convicted of fraud? And so all of a sudden you've done all this work and you have to drop that company. We wanted you to have at least 2 more in the wings that you could go to quickly. But yeah, no, it's just one company. How can we handle a company that is not willing to give us So in that case, I mean, if they're not willing to give you kind of financial information projections, you probably need to find another company that will, because that's a big part of the competition. Our team has yet to receive feedback on our listed 3 companies. Are those still being reviewed? Christy, do you know where we are on that?
Yeah, so most teams already received theirs. I'm still waiting on, I think, 1 to 2 associates to review them, but I'm chasing them. Should be able to get it to them as soon as possible.
Yeah. So we'll follow up with that and try to get that feedback out tonight for you guys. So Kel makes a great point. A company is unlikely to just share the information if you just shoot them an email and ask for it. But if you shoot them a note and just say, hey, would you be willing to do a call with us? We think your business is super interesting. And then tell them about the competition, ask really smart questions, show that you've done your homework. Oftentimes they may be willing to share some of the data around the business. And look, maybe they're not willing to share like a full built out financial statement with you, but they could give you interesting data points that would be sufficient. So they could say, like last year we did $1 million in revenue, which is up, from 200,000 the year before. We're growing so fast. It's so exciting. This year we think we're going to do 5 million in revenue, right? Like sometimes you can get information like that can be really beneficial. And then you just ask really smart questions. And if you can engage with the entrepreneur, they'll oftentimes answer a lot of those questions. Just wanted to clarify, the investment memorandum which we submit as a Word doc is the deal screen write-up described. Can you show us an example? Okay, so just to clarify, you don't have to write an investment memo. You just have to do a deck. And the deck includes these different slides or sections. So an example might look something like you're going to have a title page, which is going to be like the company logo and your team name and your team members. And then the next slide is going to be the offering. And it's going to be like, we recommend an investment of $1 million in this convertible note, which has a $10 million cap and a 20% discount and a 10% interest rate. Right. And then you're going to have the description of the business. And this might be a couple slides, right, where you're talking about, well, the company does this and this and the other thing. And this is like how they position themselves strategically. And then you'll talk about the management team, like this is the right team to do this business because look at their backgrounds and how awesome they are. Then you'll have another slide that'll be like the market analysis where you're showing like charts, showing like the market size and it's growing and maybe having a few key drivers behind that market. Then you'll have competitive landscape where maybe you plot out all the different competitors and how they compare against each other and how your company is best positioned. Remember, we threw out that strategy map where you could throw the different competitors on there based on two metrics that really matter. And then you've got your historical and financial projections. So that could be, the financials you put in there and your exit strategy. So you talk about, that could be a slide for exit strategy where you say, well, we think this company is going to get acquired and it's probably going to get acquired by one of these 3 types of acquirers because of XYZ reasons. And then you'll have your returns, like we're going to put in $1 million. We're going to, if everything works out well, we're going to get $100 million back. And then you'll condense it all into investment thesis to really hammer it home. And then you're done. So that's the idea.
Okay. Sorry, Peter, I was the one who asked the question. Should we disregard the bottom part of the email that was sent out recently about the Word document for the investment memorandum and just focus on the slide deck?
Yes. And
okay.
We'll send out another email to clarify that. I apologize for the confusion.
Awesome. No problem. And in the slide deck, are we also able to include an appendix and reference that throughout the slides?
Absolutely. 100%. Yep.
Cool.
Yeah, we know that. So in years past, this competition took place over about 2 months. And this year we really condensed it. So we're cutting out the investment memo requirement and just having the presentation. So you guys have enough time to pull it all together.
Sounds great. Thank you.
Yep. Any other
Peter,
questions? Yes.
I have a question.
Go for it.
Instead of like the EBITDA to use for comparison, what other alternatives is there? Because I know you mentioned that like the net income's like negative generally in small businesses. I don't know if that has an effect on how we should find a good financial, I don't know, alternative to EBITDA.
Yeah. So usually you want to start at the top of the income statement and work your way down. So you start, the further down you can get, the better. But if things turn negative at any point, you can't really use that number, right? So revenue, enterprise value to revenue is really helpful. You can also do enterprise value to gross profit, right? So revenue minus COGS, cost of goods sold. You could also do enterprise value to EBITDA. My guess is that most of you are going to do enterprise value to revenue, and that's okay.
Thanks.
All right, yeah. Sean, so another question, just to kind of bring it home or clarify. On the 7th, you're only required to submit a slide presentation. No memo. But it should be a dense PowerPoint slide deck with all the relevant information on it. And feel free to put additional context or text into the notes section of the PowerPoint as well. Any other questions? All right. Well, if you have any that come up in the meantime, please feel free to email Christy, and we will do our best to get back to you guys. We're really excited to see the stuff you guys submit. And thank you all for joining us this evening and for participating in the competition. Have a wonderful night.
Thanks, you too.